Gold right now, as of time of this recording, is trading at $1,764.08 US. It's up $11 on the day. Across the last week, it's seen a nice climb from the low to mid 1600s to over 1760. So we've had a nice over $100 move in gold in the last week. That is nice to see. As of time of this reporting, silver is down a dime to 21.51 after rallying pretty strongly the last few days. It started off about a week ago, 19.50. Now it's trading at 21.50, nice $2 move there. So both silver and gold have done pretty well as of late, while the rest of the market seems to be experiencing some problems. As of time of this reporting, and this will change by the time you see the video, that about midway through Friday, we're sitting down on the Dow Jones Industrial Average 0.74%, or down 250 points. The S&P is down 0.01%, or down half a point, about even really on the day. The Nasdaq's had a nice little bit of rally on the back of some bad news, some layoffs in the tech sector. It's at $70.85 up today to close, or trading right now at $11,184.99. The big one, of course, is going to be the CPI. It came under what people expected. The economic experts thought that it would cool a bit, down to 7.9% year over year. Our CPI is officially 7.7% year over year, which is a 0.5% less than what it was last month. The administration is claiming to victory basically over the fact that we had a lower inflation print, but I'll remind people it's still much higher than what we want to have and much higher than the federal funds rate. And so they're going to have to continue tightening the central bank will until they at least reach the CPI level, or we're probably going to go into a deep recession. We'll have to see what the Fed does going forward. The federal budget is a negative $88 billion for the month, which basically means they're running $88 billion short. Now, this time last month, it was $165 billion short. It's a little bit better, but we're still running big deficits, which does not spell well for the economy, especially with the underlying economic data not being too great. Overall, what does that look like? It looks like we had a little bit of a rally in the broad markets, which has not been particularly strong, with the Fed continuing to tighten with some negative economic data coming out. Overall, the markets are still selling off a little bit, although we've had a little bit of a break, and the jobs numbers came out a little bit better than expected, although not as well as last month. And also because you've seen a little bit of positivity in the inflation rate, even though it's still high. That's given the market a little bit of reason to be a little bit optimistic. And if you count earnings season coming up with the holidays, Thanksgiving, Black Friday, and Christmas coming up, one could expect there to be a temporary or a little bit of a recovery as long as retail sales come in strong. And it's not all money being spent on credit cards, but people are actually spending free cash. And it's helping out the retail sector. We could see a little bit of a jump in some of the corporate earnings. The Q3 corporate earnings weren't great. A chart I put out on JM Bullion's blog and talked about on their YouTube channel recently was that since 2018, outside of a short recovery from the pandemic or a restart from the pandemic, we've had negative corporate earnings dating back to 2018. And the only reason for 3 or 4 quarters they were positive after the pandemic is because we restarted up. So we were starting from a lower number, even though we had never recovered to the number before the pandemic. So in other words, we had this much economic output, pandemic, then we started to recover, but never recovered back to where we were before. And so the numbers look positive because we went from a really low trough recovering a little bit, but they never recovered. And since we've had that little boost, the last 3 or 4 quarters, they've come back down again. So the overall trend for corporate earnings the last 4 years has been down, with a little bit of blip post-COVID that never made up for where we were in 2018 when we started that downward trend in corporate earnings. So corporates have not recovered. Labor force participation rate is still in the 62% range. That has not recovered, dating back all the way to the tech crash in 2000. So fundamentally, the economy has not recovered from either its 2008 period or the pre-2000 period in a lot of these economic fundamental statistics, and which is why we cover them. We fully expect, however, at some point in 2023 that we'll figure out whether the economy is recovering and going to a recession. I wouldn't look at Q4 economic data as potentially saving the economy, because Q4 always tends to be a bit bigger because of shopping season or retail season. We'll have to see how that retail season compares to previous retail seasons, whether we actually had growth and whether that's affected some of the economic fundamentals before we determine where we're going in 2023. Definitely think that most of the economic pundits and financial analysts are waiting for January, February 2023, especially post-election, seeing who comes into the House and whether the Republicans want it back or the Democrats remain control, what policies are going to come out of the Congress at that point. So I think people are holding their breath to see all of these things. And so I think that we'll get more of a resolution on where the economy is really going in the first quarter of 2023.